Hey guys, Rami here and welcome to my Investing 101 How to Invest in Stocks Beginner's Guide video. First of all, I'm not a financial advisor or giving investing advice. This is just my take on investing where I'll explain to you the 5 steps or 5 ways of investing. You can use these as stepping stones and move from one to the next, or you can diversify your portfolio in all 5 of these things that I'm going to cover in this video. And I'll also share with you what I'm personally doing in terms of investing to better explain things. All I ask in return is please hit the like button on the video. And if you're new here, please consider subscribing if you like this kind of topics and other smart money tips. Thank you so much. All right, so investing was a strange concept to me not too long ago. I always thought it was like gambling and I don't want to risk losing any money. And I'd rather just save it in a savings account or a high interest savings account. How silly is that? Glad I'm over this phase in my life and I'm opened up to investing now. And the first place I was comfortable investing in was with Roboadvisor. Now, what is exactly a Roboadvisor? It's basically a tech financial company where you set up a profile online by answering some questions about yourself, and based on your answers, they'll determine your risk tolerance level and create an automatic stock portfolio for you. There are many platforms out there for this type of investing, but the one I use and like a lot is called Wealthfront. I just want to mention that this video is not sponsored at all, and any platform I mention here I personally use and enjoy using, and that's why I recommend it. So the main benefit of setting up an account with a company like Wealthfront is that everything is automated for you. And you can also get some great benefits that would be otherwise complicated to do, like tax loss harvesting, which helps you save some money on taxes. Plus, they also automate dividend reinvesting, among other things. So of course, something like this will come with fees, but I would consider the fee here negligible. Wealthfront charges 0.25%, which means that if you even have $100,000 with them, the fee you'll pay is about $20 a month. That's not bad at all, given all the benefits of not having to worry about your money or do administrative work to manage it. They basically do everything for you. With something like this, I would consider setting up an automatic transfer from your bank account to your investment account, and I would do it on a weekly basis. When I started, I just put one lump sum there right away and then did nothing for a while. Then I started depositing monthly. But with the way the market has been behaving the last couple of months, I decided to make my automatic transfers weekly. And that is because the market has been very volatile and moving in both directions quickly, and I wanted to take advantage of something called dollar cost averaging, which means that when you consistently buy into the market regardless of how it's performing, so you buy in the highs and you buy in the lows. This method supports the famous saying that time in the market is better than timing the market. It's very difficult to time the market and try to buy the bottoms and then go ahead and sell the highs. And with the craziness of the market right now, it's even harder. So dollar cost averaging means that when you buy some in the high and some in the low, when you're investing in the long term, your cost basis will be reasonable. So when you decide to start taking money out from your account in 10, 20, or 30 years, you will have made some nice gains regardless, because your average cost is theoretically less than what the value will be 10, 20, or 30 years from now. So the next level or next way you can invest your money is in ETFs, exchange traded funds. So the benefit of this is that you select a fund that tracks the whole market instead of buying specific stocks. Great ones are VTI, which tracks the total market, but I personally prefer ones that track the S&P 500 like VOO or SPY. These ETFs track the performance of the top 500 companies in the US, so it's like buying a small stock in every one of those top 500 companies like Facebook, Microsoft, Johnson & Johnson, Google, Amazon, Apple, and many, many others. This gives you huge diversity because if one of those companies fails, you have many others to help your money keep growing, and your ETF prices will continue the upward trend over the long term. And again, you're going to want to consistently invest over a period of time instead of putting a lump sum of money all in at once. And by the way, when I mean dollar cost averaging, this is something you don't have to do over your lifetime or several years. You can do that, of course, if you can and can afford it, and that's something you want to do. But even if you want to invest just $1,000, don't put it all in at once. You can put in $100 per week for 10 weeks to keep buying those ups and downs over that period of time. A disadvantage of ETFs is that something like SPY or VOO having all those 500 companies included in them, maybe you don't like some companies in there based on the industry, or there are companies there that you don't believe in, but you can't customize that ETF. So you're going to feel like you're putting money in something that you don't want to. So a way to avoid this is going to be in level 4 coming up, but let's get to level 3 first, which is dividend ETFs. Actually, even before that, you might be asking yourself, okay, I'd like to invest in some ETFs. Where do I do that? There are several platforms. I'm currently using 3 different ones. I'm using SoFi Invest, Robinhood, and Webull. You'll find referral links to all of them in the description below, where you'll earn some free money, including up to 2 free stocks from Webull, with one of them potentially worth $1,400. All right, now back to dividend ETFs. 2 that I like are SCHD and VIG. SCHD is a combination of 100 companies that pay good dividends like Coca-Cola, Pepsi, Texas Instruments, Exxon, and others. VIG holds 183 dividend-paying companies like Walmart, Visa, McDonald's, and other companies. I like dividends because it's kind of like the ultimate passive income source. You make money just by holding onto the stock without having to sell it at a profit. These companies just make so much money that they pay their investors some of that money just for being an investor. Some companies do it monthly, others do it quarterly, or whatever. So in order to make this really a passive income source, you'd have to hold a few $100,000 in stocks to make a good income just from dividends. But starting small is a great way, because whenever you earn those dividends, they'll be automatically reinvested to buy more stocks, which will give you more dividend. It's just a great positive cycle. Moving on to level 4, and that is industry-specific ETFs. So this is how you can avoid certain industries that would otherwise be included in regular ETFs. Let's say you like the airline industry right now and feel like it's going to eventually bounce back like crazy, or same thing with the energy sector like oil and gas companies. So for the airlines, the ETF is JETS, J-E-T-S. So this ETF holds stocks for American Airlines, Delta, Southwest, JetBlue, and others. So you're investing in the US airline industry as a whole, not specific airlines. And for the energy sector, there's XLE, which holds stocks in Chevron, Exxon, and other companies in the same industry. So there's pretty much an ETF for every industry you can think of. So if this is your investing strategy, you can pick ETFs in the industries that you feel have the best chances to meet your investing goals. Finally, we have level 5, and that is stocks. This is where you'll have to put a lot of research and emotion together by picking specific companies. The benefit of investing in specific companies is that you have a much higher upside and a greater chance of reward, which also gives you a large risk. A great example of this is Tesla. Not long ago, within the last year, their stock price was around $180 or $200. And in February, it almost reached $1,000. So that's a gain of about 500%. You will not get type of gain with ETFs, but at the same time, a similar stock can collapse just as fast. That's why you have to pick these stocks carefully and also diversify. Don't put all your money in one company. Try to diversify between different industries and also a few companies within an industry. Picking a stock is something that really depends on you, and it differs person to person. But I would just recommend that you look into stocks that have performed over many years in the past and have a strong history, and they offer products that you believe in and you believe that they are useful and are here to stay. Obviously, other companies can pop up in the future and disrupt certain industries, but that's just the nature of the game. You can also put some research in new companies that are offering things that you believe will be needed in the future. Right now is actually a good time to do some research, since a lot of things are probably going to change because of this pandemic, and it will affect a lot of industries. I'm personally looking into companies that support the idea of a low-touch economy. Still haven't found much, and whenever I hear about a company that can potentially produce a treatment or a vaccine, it's too late and the price of the company already shot up by like 200%. A great example of this is Sorrento, and their stock just jumped 158% on Friday. That is insane. So that's it, guys. This is my quick investing 101, how to invest in stocks beginner's guide. Hope you enjoyed the video. Make sure to hit the like button. Check out the links in the description to get your free stocks and your free money. Subscribe if you haven't already and click that notifications bell. Thank you so much for watching. Please stay safe, stay healthy, and I'll see you in the next video.